Hey traders! So today I want to get into one of the most common questions that traders have, and that is how to spot reversals in Forex. I am producing 2 videos per week packed with awesome Forex tips, tricks, and strategies to help you get started in Forex trading, so make sure you hit that subscribe button to be notified of my future videos. So reversals are simply areas on a chart where the price of the market bounces from the direction it has been moving in and then moves in the opposite direction. The more times that the market has bounced from this area, the more important that level is. Traders look for areas where price has reversed in the past to see where it might happen again to then profit from the move in the opposite direction. What is difficult is finding these areas, and that is what I want to help you with today. Okay, so tip number 1 is support and resistance levels. Support and resistance levels are levels on your chart where price has bounced off or reversed several times before. As it has bounced off these levels in the past, if price now reaches one of these levels again, then price may well bounce once more, and traders can capitalize on that bounce. When I draw these levels, I differentiate between monthly strong levels, weekly medium levels, and week daily levels. If price has reached a monthly level, it is more likely to bounce off that level than if it has reached a weekly level. And conversely, if price has reached a weekly level, it is more likely to bounce off that level than if it has reached a daily level. So why is this important? Well, because it helps you choose which pair to trade. If you see that a pair has reached a monthly level of support and/or resistance, and another pair is at a daily level of support or resistance, a trade is more likely to be successful with the pair that is at the monthly level. I created a video which goes into far greater depth about how I draw trend lines. Check it out by clicking the link in the description. Tip number 2 is trend lines. So trend lines are a sloping form of support and resistance levels and work in conjunction with horizontal support and resistance levels that we just talked about. Trends are either uptrends or downtrends. In order for an uptrend to be valid, it must have created 2 higher highs and 2 higher lows. In order for a downtrend to be valid, it must have created 2 lower lows and 2 lower highs. A trend line is then drawn. In an uptrend, the trend line is drawn below the trend and must join the 2 higher lows. Traders will then look for the price of the market to move back or retrace towards that trend line. Once price reaches this point, it is a first indication that price may bounce off this level, and traders will look to place a long trade that will profit from the potential following bullish price action. In a downtrend, the trend line is drawn above the trend and must join the 2 lower highs. Traders will then look for price to rise back to that trend line, again as indication that price may bounce from this level, and they can place a short trade which profits from potential following bearish price action. I have created a great video that goes into much greater depth about how to identify trends and draw correct trend lines. Check the description for the link to this video. And tip number 3 is Fibonacci levels. The Fibonacci indicator is based on the mathematical genius that was Leonardo Fibonacci. This indicator is used in a trending market, where it has by far the greatest effect. There are 5 main levels, which are the 23.6% level, 38.2%, 50%, 61.8%, and the 76.4% level. In an uptrend, the Fibonacci indicator would be drawn from the most recent higher low to the most recent higher high. You would then drag across your screen so that the levels cover your chart. You can see that the levels appear when you do this. From this point, traders would be looking for price to retrace back to one of these levels. When price comes back and looks like it is stalling at one of these levels, this would be an opportunity to enter a long trade and profit from the potential following bullish price action. In a downtrend, The Fibonacci indicator is drawn from the most recent lower low to the most recent lower high. Once again, drag the indicator across your screen so that the levels cover your chart. From this point, traders will look for price to retrace back up and stall at one of these levels. This could provide you with an opportunity to enter a short trade to profit from the potential following bearish price action. The great thing about this and the other two indicators is that they can be combined together. If, for example, price has retraced to a support and resistance level and is stalling, it could be a good place to enter a trade. But if you combine the indicators and also find that price is on a trend line and a Fibonacci level, then this increases greatly the likelihood that price may reverse from the point you are looking at. For a fantastic video that explains how to combine support and resistance and the Fibonacci indicator, check out the link in the video description below. Okay guys, so there you have it, 3 top tips on how to spot reversals in Forex. As I said, one of the most important things is to start combining these indicators together to give you a much better indication of where price may reverse from. That's why I have put together a 100% free ebook for you called the 3-Step Trading System, which details the basic strategy that I started out with, combining several of these indicators together to trade successfully in the markets. Simply go to www.theposhenglishtrader.com/3steps to download that now completely free. Once again, simply type into your browser address bar www.theposhenglishtrader.com/3steps or simply click on the link in the video description below. To be notified of my next video, make sure you hit that subscribe button and hit like to let me know what you thought of the video. Okay guys, until next time.